This week, I'm going to talk to you about some economic data points from the recent past, something from today's headlines, and something that's coming down the pike next week. Let's start with the recent past, and that was the June non-farm payroll report that came out on Thursday of last week. And going into that report, and I can pat myself on the back about that, is I told you on one of these things that the US equity market would really like to see a jobs growth number for June that was better than what the market expected. And that, to people who don't follow the stock market too carefully, that should not seem like a bold prediction, because you'd say, well, isn't more jobs good for the economy? Isn't that good for stocks? But in actual fact, the answer to that is not good for stocks, because the way the market is right now is the market very much wants to see the Fed cutting interest rates, and seeing stronger than expected job growth actually means lower chances that the Fed is going to be cutting rates, or the number of rate cuts that we're going to have towards the end of the year. And therefore, the equity market, the stock market, would normally greet a better than expected jobs number negatively. So why did I say the Thursday number was a stronger than expected number was got to be positive? Well, first thing is that the market pretty much thought there was no chance that the Fed was going to cut rates in July. So the June number being weaker, if it come in weaker, wasn't going to increase the chance of a July rate cut. There is no meeting in August, so the next meeting after that is September. And I didn't think a June jobs number would have much impact on the chances of a rate cut in September. So it wasn't going to be impactful on the short-term interest rate predictions. Meanwhile, what the equity market really was fearful of is that the Fed's decision not to cut rates now and to hold off to see the impact on inflation of the tariffs, is a mistake, meaning that the US economy, which is obviously slowing down, is actually slowing down more than the Fed thinks, and that keeping rates where they are now is actually a mistake on the part of the Fed. And then the US economy, without those rate cuts, will decline more quickly than need be. And of course, that would be negative for the stock market. So as it was, the number came out on Thursday. It was a little bit better than expected. If you're an equity investor, it said, well, maybe the Fed policy is correct. Maybe the Fed is correct. They can hold off on doing any rate cuts till September. And the stock market went up a lot on Thursday. It since has pulled back a little bit on Monday and Tuesday, but we're still higher than they were when I was recording last week on Wednesday. Okay, that takes care of the past. Now we're going to go to the present. The thing I wanted to talk about from the present headlines is Treasury Secretary Scott Bessent was talking to reporters, and he said that this year the federal government, or the Treasury, was going to collect $300 billion in revenue from tariffs put in by the Trump administration. $300 billion is a big number just by itself, but also if you consider during the first half of the year, the number is only about $100 billion. That means that in the second half of the year, he is saying that the Treasury is going to collect about $200 billion in tariff revenue, or a $400 billion a year annual pace. That is much higher than what the CBO was reckoning with when they were analyzing what the impact of the recent budget, that the Trump's big, beautiful budget that just recently got passed by Congress and signed into law. Now, you all know that Elon Musk got very angry about the big, beautiful budget because he thinks that the US has too much debt and the deficits are too wide, and that the government should be taking action, or the politicians should be taking action to reduce the size of annual deficits. And of course, Trump's big, beautiful budget doesn't do that. It actually makes it worse. so that the U.S. debt to GDP ratio will continue to grow, and that really annoyed Elon Musk. Now, defenders of the big, beautiful budget say no, that actually the debt to GDP ratio will not get worse, and that's because there's so much good stuff in the big, beautiful budget that the U.S. economy is going to grow more quickly than what the Congressional Budget Office expects, and that therefore the debt to GDP ratio won't go up. The other thing, besides the fact that the big, beautiful budget basically cuts income tax and that encourages capital formation, and that causes people to invest, and that boosts the economy. Besides that part of the growth, the other thing going on in the Trump administration is attempts to regulate U.S. businesses less. So deregulation is generally, makes it easier to run a business, makes you want to invest more, probably increases your profitability. And they're saying, yes, that's another good thing, and that's why growth's got to be higher. Is it possible with this extra tariff revenue, will the Trump big, beautiful budget actually not increase the U.S. debt to GDP ratio, which would be generally a pretty good thing? Probably not. It's probably not enough extra money unless you do get the higher growth. But without this extra tariff number, maybe it was completely unrealistic you would get enough extra growth over the next 10 years to keep that debt to GDP ratio from going up. But maybe with this extra tariff revenue, you only would need very good GDP growth, something you shouldn't really expect, but something that's more in the realm of possibility. And you would see the debt to GDP ratio not get worse. And maybe that's not good enough for Elon Musk, because he would like to see things improve rather than just stay at a bad level. But still, staying at a bad level is a lot better than just getting worse. Now let's talk about the future piece of economic data that I wanted to talk about, and that is next week's CPI data. Now, I've already touched on the idea that the Fed has some reason to cut rates now, because recent inflation numbers have indicated that inflation is going well below their 2% target. I think the last three core CPI monthly data was like 0.1% or a little bit higher than that month on month, and it averaged out to about a 1.6% annualized rate over the last 3 months. So definitely inflation is below the Fed's 2% target. But of course, now we're going to get into the months where the impact of those tariffs are actually going to hit the inflation rate. So we're going to start seeing that in the upcoming June CPI data that will be coming out next week. And as I just said, the recent data have been around 0.1. Well, this one's expected to be 0.3. So a lot of that will be impact from the tariffs. So what am I saying here? I think all around the world, we've had better than expected inflation numbers, meaning that the data that's been coming out in countries all around the world have been lower than expected. We just had a producer price index data from China that was even more negative than expected. A couple of days ago, we had Thailand's CPI data come out that was also negative for consumer inflation in Thailand. So anyhow, my point is, it is possible that these forces of disinflation, that we know the impact of the tariffs are there, but it is possible that the forces of disinflation in other parts of the economy will overwhelm that. And maybe instead of that month-on-month inflation rate jumping from 0.1% in May to 0.3% in June, maybe it's only 0.2%. And I think that would be one thing that could keep the U.S. stock market on its current positive frame of mind. We're only 1% from an all-time high, and we need more positive info to keep it going to new highs. and maybe a lower inflation number has got to be just what the doctor ordered. Anyhow, that's my talk for this week. I'll talk to you again next week. Bye.